great future. We're talking real money.
Hello, friends. It's just another Q&A Friday. Hello, welcome to Talking Real Money, the podcast. I'm Don McDonald, the host of the Friday Q&A podcast. Well, most of them. Although sometimes Tom and Roxy do them. So this is one of them. You called in questions. I'm going to try and give you answers. By the way, you sent those questions in, spoke them in, at talkingrealmoney.com on the little button that says Contact Us, where you can type them to if you want. But you can also, if you want to have a conversation, this goes up on Friday, and then the very next day, Tom and I get together via fancy technology, and we do a radio show in Seattle on Northwest News Radio where we take calls. And you can call us wherever you are in the world at 855-935-TALK. That's 855-935-8255. Actually, I think that only works in North America. So that may only work in North America. But give us a call on Saturdays from 3 to 5 Eastern time. 3 to 5 Eastern. 855-935-TALK. 855-935-8255. So I think we have 5 questions for you today. So let's get underway with the first one.
Hello, Tom and Don. This is Charles from Atlanta, Georgia calling. Hope you're doing well. Really enjoying your podcast and all that I've learned. Want to run this scenario by you. I'd like to retire at 63. I'll be getting a $30,000 pension starting when I'm 60, a $50,000 pension starting at 63. I currently have $54,000 in my IRA, $440,000 in a 401k, $130,000 in a Roth 401k. I'm putting away $20,000 a year into the Roth for the next 8 years. I'm 55, and my employer offers a 5% match. So I'd like to retire at 63 and withdraw $40,000 a year for a total of $120,000 in income, roughly, trying to stay in that 12% tax bracket. Do you think that I'll have enough to retire at that point, assuming a 7% return? Really appreciate you guys and all that you do. I am a reformed gain/return aholic, and now have mended my ways and have gone into large cap, small cap, international value funds. Thank you for all you do.
Takes a strong constitution to give up the game, doesn't it? But good for you. And good for you in your quest for an early retirement. I hope you figured out what you're going to do when you get there, although you have 8 years to figure that out, and that's an important part of the process. But you're looking at the financial stuff pretty well. You're going to have $80,000 for sure in income, and then you want to add 40 from your portfolio, which at the end of 8 years, without any growth in the portfolio whatsoever, just with what you're adding to it, is going to be close to $800,000. So you're almost there without the market doing anything. If you assume that the market does 7% over the next 8 years, then you're right there. You're there. And if that $30,000 extra you're getting at 60, if you invest that for the next 3 years into your retirement, again, assuming a 7% return, you've reached your goal. You should be able to. You should be able to, using the rule of the 4% rule, or using a 5 flexible. And I think a 5 flexible, if you have flexible living ability, then doing a 5% annual flexible without adjusting for inflation has, in the past anyway, been shown to be a very effective income strategy, because the money tends to last at 5%, or at least, again, based on the past, it has lasted for almost anybody's possible life. So I think you're in great shape. Thanks for the call, and thanks for listening, and thanks for investing as you should invest, sensibly, diversified. Take care. Next question. Here it is.
Tom and Don, I know you recommend VT, but I'm wondering if you can speak to how that is similar or different from SPGM. Thanks.
I actually love these questions because it gives me an opportunity to do some studying of a couple of funds that I haven't done in this way. VT is the Vanguard Total World Stock Index Fund, as you probably know. We talk about it a lot. SPGM is the SPDR MSCI Global Stock Market ETF. Pretty much the same fund. They're supposed to be globally diversified, U.S. and international stocks. They have about the same U.S. to international ratio. It's a 60-40, close. You'd think they would be almost identical, but the funny thing is they're not. The SPDR fund, the SPGM, is 50% more expensive, although we're quibbling over thousands of a percent. Or hundreds of a percent, I should say, not thousands, hundreds. The SPGM is 0.09% and the VT is 0.06. VT, though, has almost 10,000 stocks in the portfolio, so it's massively diversified, whereas SPGM has less than 3,000 stocks in the portfolio. The returns have been very similar, within fractions of a percent, and those are probably attributable to the level of diversification. The Vanguard portfolio skews a little smaller, and I do mean very little, because of the bigger portfolio, and the SPGM goes a little bit more value-y, but again, it's just minor stuff. And again, the return's very similar. The SPGM has tended to be a little bit more volatile, at least comparing comparable years one to the other. The standard deviations are, VT is 15 over 10 years, and SPGM is 15 over 10 years. So really similar. Vanguard gets a slightly lower overall risk score from Morningstar. So a lot alike. But if I had to choose between the two, one, I choose the cheaper one. Two, I choose the greater diversification, which is why we've been suggesting Vanguard forever, because it's hard for anybody to compete on cost. And generally they go for the right diversification for that asset class, which is, if they're index funds, it's all of them. They don't trim it down to make it more manageable. We have all kinds of ways to call or ask questions, because we truly, Tom and I both love answering your questions. The easiest way, the 24/7 way, is to go to talkingrealmoney.com. Upper right corner, you'll see a thing that says Contact Us. You click that, you get a form you can fill out, or you have a button where you can record your question. You can also, though, call us every single Saturday, unless it's a mega holiday. And the phone number to do that is 855-935-TALK. The time to start doing that, right around or a little after 3 p.m. Eastern Time. That's on Saturdays. We have more questions to get to. Here's the next one.
Hi, this is Robbie in Herndon, Virginia. I bought BMCAX, BlackRock Advantage Large Cap Growth Fund, back in 1997 using $7,500 I inherited from my grandmother on the advice of her financial advisor. He was with LPL, and I've since moved it to Vanguard into my taxable brokerage account. It's now worth almost $50K, and I'm looking to divest and move it into low-cost ETFs, but I'm not sure of the best tax-efficient strategy. Can you walk through how I should handle the cost basis reporting and whether there are smart ways to minimize the tax hit? Thanks.
Well, there's probably only one good way to minimize the tax hit, and it depends on a lot of variables, which is why planning is so crucial, and knowing lots of facts. One, you got to know your tax bracket. Let me just give you an example. I'll just give you a real quick example. Let's say you make $100,000 a year. You're married, you make $100,000 a year. You've got this $50,000 sale which is going to result in a long-term gain of about $6,400 at the 15% bracket. Because of your income, you're going to pay 15% on that if you're at 100,000. However, let's assume you're at 100,000 and you split it. You sell half in 2025 and you sell half in 2026. If you're at $100,000, that works some real magic because it kicks you below the zero long-term capital gain cutoff of $94,000 in total adjusted income, which would mean 0%. Now, that's just a hypothetical example because I don't know all the other information. But there is a way to structure this unless you have very, very high income. If you have middle-class income, you might be able to spread this out over enough years to avoid some or all of the capital gains. Although if you're in the couple $100,000 range, you're just going to pay the $6,400. So, yeah, it requires some tax planning and it requires a lot more specificity. And that's why we say whenever you're thinking about making a large sale of securities or you're going into retirement trying to generate income off of your portfolio, that you sit down and do some advanced planning work. And part of any good advanced planning is going to be a tax component. Thanks so much for your question. We still have 2 to go. So let's get to the next one.
Hey, Don and Tom. This is Joe from State College. I have 2 questions for you. First, I'd like to know if you have any recommendations for online resources or books where I can learn more about financial planning to include investing, taxation, Social Security, etc. My second related question is, do you have any recommendations for online software, Monte Carlo simulators that I can use? Looking forward to your response. Thank you. Love the show. Keep up the good work.
Well, it sounds to me like you're not looking for a book on the basics of investing. You really want the down and dirty on financial planning. I'm not sure how sophisticated you want that to be or how sophisticated you are. The mainstream books, if you want financial planning that's approachable, then you might look at Harold Avensky's book, which was called The New Wealth Management. It's a prosumer level book. It's like professional consumer. So that's a good place to start. Some of the Boglehead guides have been pretty good stuff, but they're more generic. They're more consumer focused. There is, if you really want to go crazy, you want to go nuts. I don't even know if you can get it. Let me just look and see if you can even get it. It's called the CFP Board's Financial Planning Competency Handbook. And yeah, you can buy it at Amazon for $100. So yeah, it is available. Books just generally that I like. I love Jason Zweig's Your Money in Your Brain. I just absolutely adore the book. I think that it helps a lot. Carl Richards' book was actually pretty good. It's not complicated at all. The one-page financial plan. I always liked Carl Richards. If you want to go back to crazy stuff, you can go back to Ben Graham, look at The Intelligent Investor. Those are the ones that come to mind. As for Monte Carlo simulations, you could spend a lot of money on the professional stuff, but I don't know that you need to. I know the old school, there was a thing called Portfolio Visualizer that allowed you to run a simulation. But I tell you, lately I found that, particularly with ChatGPT 5, that ChatGPT's Monte Carlo simulations are pretty robust. At least they appear so to me. They, let's see, they can run like 10,000 random simulations using historical or assumed data. So, and you can, if you don't use it very often, you don't get, it's free. I mean, that's a heck of a deal. And I don't get paid anything by OpenAI for saying nice things about ChatGPT. I've just found it, if you verify your sources, I found it incredibly helpful in doing research. And Monte Carlo simulations are one of the ways I've used it a few times just to kind of see what happens. So that's one place to go. And those are some book ideas. And remember, the number on Saturdays is 855-935-TALK if you want to actually have a conversation with us. If you want to send in questions, just go to talkingrealmoney.com, click Contact Us, and either type them in or speak them in. If you speak them in, they'll get used on Friday's podcasts. Okay? Let's get the last one in for the day.
Hey guys, I have a question for you. I was looking at my investment portfolio and I was trying to diversify it a little bit more and was thinking of doing the Target Retirement Fund, which I know you guys aren't a huge fan of, but I was kind of thinking of doing the stair-step approach, kind of like a CD ladder, since we want to be a little bit more invested in stocks instead of picking the day that, or the year that my husband retired. I just went further out because I'm assuming that it'll be more in more stocks than bonds. So how would you feel about having a portfolio that's has an investment style like 2045, 2030, and so on, and maybe just do 25% in each? Will I get the diversification I want? Also, I have a little bit of international. I've listened to Paul Merriman, and he's always talked about having international and small cap. So I have a little bit of that sprinkled in too. My goal is just for us to be super diversified. So I'm wondering if I'm overcomplicating things, or does it make sense for me to do that? Last part of my question is, my husband and I have a little bit of an age difference. So I'm thinking that even though he's retiring within the next 7 years, we don't really need access to that money because he has two retirement. He's got pensions and things like that we could work with. So just thinking we could be a little bit more on the risky side, and just wanted to see what your thoughts were on that. Thanks so much.
I feel a little bit of overthinking in there, but not too much. You have addressed our problem with target date funds, and that is the assumption that you want a certain level of risk at a certain point in life, which isn't, as you illustrate, necessarily accurate. The way to get around that is exactly what you thought. Go with a longer maturity, because the longer maturity portfolios, they glide path their portfolio, which means they lower the risk as time goes by. So if instead of getting a 2030, you get a 2045, you're going to have a much more aggressive stock-oriented portfolio. So yeah, that works. I don't know that it doesn't sound like you need to ladder target date funds. That seems extreme. You didn't say which target date funds you were looking at, but if your target date funds have an international component, you may not need as much or any international exposure, again, depending on the fund. I think you should have closer to half of your equity money overseas, 40 to 50%. Tom thinks more like 30, 35. We're quibbling. We just think you should have it, as does Paul. So, yeah, maybe a little overthinking. I could see splitting the baby, saying 2040. Let's go 2040 on that portfolio. That's going to give you let's look at Vanguard's. The 2045 is just north of 80% equities and a fairly large chunk international. So that's good. The 2040 is 75-25. So not a huge difference between the two. It depends on, again, your comfort with that extreme volatility that the stock market can occasionally bring. The differences aren't going to be dramatic. I think it's like an 8% equity difference. So it's like 82, 83 in the 2045 and 75, 76 in the 2040. You don't need to make it more complicated than that. You really don't. Thanks for the question. questions. Thank you all for your questions. And thank you all for listening. Lots of you, thousands of you. And we really appreciate you being there. I mean, to this day, you still made us one of the top 1% of podcasts in the world. And that makes us feel good. We really like that. And by the way, every single day we put up or every weekday, except for holidays, we put up some sort of podcast. And so there's a bunch of them up there. There's like 1,700. And if you tell a friend, well, we appreciate that too. And remember, call us on Saturdays at 855-935-TALK from 3 to 5 Eastern Time. And let's see what else. Oh, go to talkingrealmoney.com to ask questions. And also, if you want to see where you are today with your portfolio, even if you're a diehard do-it-yourselfer, you know it might help to have somebody take a peek at it. And I know that many of you are afraid to have somebody take a peek at it because you're afraid you're going to be sold something. And that's a very legitimate concern because the vast majority of people are going to do that. It's just the way this industry or any industry works. It's about selling. If you don't want to be sold, meet with one of our advisors at Appella Wealth. They'll do it for free for nothing for a little while. Now, if you want to hire us, we will charge you. But if you just want us to look at your portfolio and kind of give you an idea where you are or say, yeah, you need some work on this or that or this other thing, just go to talkingrealmoney.com and click on the button that says Meet an Advisor. It's that easy. Thank you again. We appreciate you so much. Take care of yourselves, and we'll talk to you again really soon. I'm Don McDonald, and we're all here talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.